Did you know that understanding where people are moving is the key to real estate success right now? You know, when I was not yet in the real estate industry, I didn't know the difference between a duplex and a donut hole. I watched in 1989, after the end of the Cold War, as disaster struck when the aerospace industry experienced massive cutback, causing thousands of jobs to disappear almost overnight. This had a devastating impact on the local economy and the Long Beach and Lakewood real estate market in Southern California, as those who lost their jobs ended up relocating to other regions with more robust job markets. Many moved to other parts of California or other states completely with better employment opportunities, particularly in industries that were growing. The lesson was clear, even for someone as green as me. The primary driver of housing across all markets is people. Without tenants or buyers, even the best market with the best weather and lifestyle can fail. Look at Detroit in the 50s. It was the 5th largest city in the US with 1.8 million people. Today, it's down to around 650,000. This population decline severely impacted real estate, with houses once selling for $1. Yeah, I know, because I bought one for fun. Real estate success, it hinges on people, not just interest rates and leverage. Without tenants or buyers, it's all irrelevant. But don't worry, I've got 4 crucial insights into current migration patterns and how you can use this knowledge to give your real estate investing a boost. First, track migration patterns. Understanding where people are moving, it's crucial for real estate success. For example, our company, which owns several million in assets, meticulously tracks migration patterns. This data has guided our investment decisions for years, leading to significant returns. For example, a few months into the pandemic, we picked up several properties in Florida after noticing a steady influx of freedom seekers moving to the area. Our worst performer resulted in a 30% increase in property value within 2 years. That was our worst one. There are 2 places that you can go to see where people are moving to. It's really easy. And you can see where they're leaving also. Redfin has a great migration heat map. The darker the orange an area is coded here, the more people that are moving there. And then the darker the blue area that you see, the more people that are moving from there. And you can see on the map that California is having some issues. So there's a lot of uncertainty there about whether that state deserves your investing dollars or not. That's how you would interpret this. You know, with Chevron and X just announcing their departure in the last few weeks, it'll only get worse in the short term as those corporations take a lot of their employees with them. A lot of people that would be otherwise living in California houses. Another place to look is on U-Haul's website. Look at U-Haul's growth index page, where they use a similar coding system. And with this, it shows where all the one-way travel of their moving vans are going and where they're coming from. When you look at their map, it pretty much lines up with Redfin's, but you do get a little different perspective here. Number 2, understand demographic shifts. The US population is projected to reach $341 million by the year 2053. And key demographics include young adults moving into rentals and home buyers aged 30 to 35 years old. For instance, targeting properties near universities can be lucrative, as students and young professionals are often in need of rental housing. So we've invested in several small multifamilies near major universities, and our occupancy rate has remained above 95% year-round. With demographics in mind, number 3 can provide even more valuable insights, and that's analyze the trends. Birth rates, death rates, and net migration, they all impact housing demand. For example, a decline in population from 2040 to 2053 suggests potential opportunities in sectors like assisted living facilities, funeral homes, or cemeteries. The big bubble though, or the pig going through the python as I like to say, right now is the peak age of the millennials. This is the biggest generation in our adult population. Right now, their peak age is 34 years old. The average age of the first-time homebuyer is 36, which represents the most demand for small, single-family homes over the next 2 years in the history of our country. And it's gonna continue far beyond the next 2 years as well. And right now you're seeing stuff like tiny homes take off. That's happening right now because we have more people at this age and not enough houses for them. You're seeing all types of innovation in housing. You're seeing those little capsule things, and you're seeing Lego homes because we've got these people out there and they need roofs over their heads. By analyzing these trends, we identified a growing and trendy millennial population in Milwaukee and invested in affordable housing there, resulting in a stable long-term income stream. Before I get to the last one, if you ever feel like you want to go faster in your real estate and get some one-on-one help, go to reiace.com, answer a few questions, and then pick a time for us to hop on the phone and we'll brainstorm some ideas for your next steps. Number 4, use data to guide investments. In 2006, Housing starts soared due to policies promoting homeownership, creating a rental gap that eventually led to a significant supply shortage. By understanding these patterns, we were able to invest in rental properties ahead of the curve, achieving high occupancy rates and rental income. Because we were holding these properties instead of flipping them like most investors, the crash of 2008 had much less of an impact on us than it did on them. And because affordable housing is at a crisis level right now, I can only imagine some sort of government intervention or investor incentives are on the horizon. So you want to pay close attention to policy changes coming up when it comes to building and development. Understanding these 4 insights will make you a better investor with better investments. But it's not so much the property that you choose that makes for a good investment. It's more the management of it. And that's why I picked this video out special for you to watch next. Otherwise, I'll see you next time. But before you go, subscribe, like, do all that stuff, and I'll see you soon. All right, thanks for watching. Take care.